Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 10th of February. I'm Daniel Lam, your host for the podcast. Many of our investors have been wondering if they should be buying gold, taking advantage of the recent fall in prices, or if they should be waiting for better entry level. Now, the picture on gold is still healthy. We believe gold's sharp decline from the recent highs was triggered by a rebound in real yields following the nomination of Kevin Walsh as the new Fed chair, which prompted a reassessment of the Fed policy outlook. This occurred against a backdrop of extremely overcrowded long investor positioning, which made the market very sensitive to both the move in yields as well as the higher margin requirements from the exchanges. Now, the fall was consistent with the elevated positioning and stretched technical signals. And the positioning has moderated from previously overbought levels, although it does remain above neutral. Tactically, gold has found critical support around the 4,400 level, which is its 50-day moving average, and it is hovering around the 4,600 to 4,800 zone. Seasonal physical demand ahead of the Lunar New Year should provide near-term support. However, tactical investors should be wary of volatility, as this demand typically fades post-holidays. Structurally, we stay constructive on gold with 12-month target price at 5,350. Now, looking back, our overweight call since September last year has proven timely, with gold rallying 39% over the period. Investor with exposure below our preferred 5 to 7% allocation should use renewed pullbacks to add, with the aforementioned 4,600 to 4,800 as a reference entry zone. Now, gold mining equities continue to give high beta exposure to rising gold prices. We chose to take profit on this trade at the end of January because the risk-reward was becoming less compelling versus the time when we initiated back in October last year. That said, gold miners' profit margins have fundamentally benefited from last year's robust gold prices outpacing the rise in cost, resulting in a substantial increase in free cash flow. And this returns in tangible shareholder returns via dividends, share buybacks, and the strengthening of balance sheet. And we will continue to be monitoring for the improving risk-reward in gold mining equity sector. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.